Hello, I'm Tony Marino, President and CEO of Tenaz Energy. Thank you for joining us for our Q3 update. Before we get started, I ask you to note our advisories on forward-looking statements. These appear at the beginning and the end of this presentation. Let's review our operating and financial results. Our Q3 25 production averaged a little bit over 11,800 BOED. That was up 48% from the second quarter of 2025. This mainly reflects a full quarter of production from Tenaz Energy Netherlands. This is the renamed unit that represents the NOBV acquisition. Our current production rate exceeds 16,000 BOED. This is nearly a five-fold increase as compared to our production rates a year ago. Production improving recently due to the impact of some of the barge activity and also coming off all the turnarounds that we did during Q2 and Q3. Focusing in on Netherlands, first of all, production in the quarter was up 66% over the second quarter, driven by the things that I just mentioned. Specifically on 10, we completed several offshore turnarounds in addition to those that were conducted during the second quarter. And as we look forward to the fourth quarter of this year, we're going to have a very active CapEx program, biggest in the company's history. And the first element of this is going to be the TEN operated assets. We're already conducting a barge workover campaign. Initial results from that are pretty positive and have contributed to this production improvement thus far. We will be bringing in a jackup drilling rig during the fourth quarter. This will be the Shelf Drilling Winner that we toured at its Danish port, where a number of retrofit activities are being conducted by the contractor. I think it's a very high quality rig. We were very impressed with the operating staff. We conducted, I think, a very effective drill the well on paper exercise, and we will begin to drill this first well at the KO7 FB drilling location, we think in the month of December. At GEMS, operated by One Dios, preparations are now underway for a drilling program that will include development and exploration wells. We think that campaign is going to start before the end of this year. And we do expect also activity on our legacy non-operated assets. This would be the drilling of the Malachite well, non-operated. E&I is the operator of this well. We have a 21.3% interest in that strong drilling opportunity. So if you put this all together, in the early part of 2026, we ought to have 3 offshore rigs operating on our Tenaz assets in the Dutch North Sea. So this KO7 operated well at 10, drilling at GEMS, and the Malachite well that is operated by E&I. In Canada, in the third quarter, production reached a record level, 2% above what we had in the second quarter. This was driven really by optimization work that we did on the wells, primarily for the wells that we drilled earlier this year. We installed a new compressor to handle gas higher gas production that exists in these wells, and that allowed us to produce both more oil and gas as a result of having that compression in place. Looking at that drilling program that we conducted in the first quarter of the year, a 3-well gross, 2.4 well net program, which drilled multilaterals in the and single laterals, all unfracked wells in the Ellerslie and Glauconite formations. Continue to have very strong rates, a little bit over 1,000 BOED gross. Net to our interest, that would be 885 BOED and a 65% oil weighting on that net rate. We're working on our 2026 capital plan, and we do expect to have a program that includes both unstimulated multilateral and stimulated single lateral wells. And we'll get more guidance and information about that program later on this year. Turning to our financial results on slide 5, we had funds flow from operations in the third quarter of a little bit over $40 million. That was up 134% from Q2 25, really driven by having the 10 assets for the full quarter, offset partially by some transition costs. Our operating netback was substantially higher, over $49 per BOE in the third quarter, up 62% from the year earlier period, reflecting these very high margin assets that we have brought into the portfolio. Net income was $25 million, 87 cents per share, compared to a loss of $2.5 million in Q3 24, or 9 cents a share. So an improvement in net income, again, driven by the 10 acquisition. If you look at our net debt position at the end of Q3 25, but this is before the GEMS acquisition, we revised that to $55 million compared to $100 million that we had at the end of Q2 25. Most of that reduction driven by free cash generated really by 10 assets that we have brought into the fold. And in addition, a $17.7 million reduction in the estimated earnout payments that we would make, that driven by a reduction in TTF pricing over the measurement period, which extends to the end of 2027. We have our ongoing normal course issuer bid program, allowing us to purchase up to 2.5 million shares. Year to date, at Q3, end of Q3, we have retired 245,000 shares at an average cost of $15.60 per share. If you look at the beginning of all the way back to the beginning of the NCIB program in the third quarter of 2022, we have retired 2.3 million common shares at an average cost of $4.15 per share. If we look at slide 6, we're going to here discuss our capital structure and briefly review our revised guidance. The net debt position of the company is represented in the waterfall chart shown in the upper left panel of the slide. Total cash, restricted and unrestricted, about $130 million as at September 30. You make adjustments for our net working capital position, which includes the current portion of the TEN or NOBV earnout, the additional long-term portion of the estimated earnout value, and the senior unsecured notes that we issued, additional issuance for the GEMS acquisition, in addition to those that we already had issued in November 2024, of total brings us to a total net debt position of $362 million pro forma for GEMS as at the end of Q3. To further, I guess, discuss this debt, we've got two components of it that we show in the lower left part of the slide. Let me just start with the senior unsecured notes. The original tranche of notes that we had were issued in November 2024, 140 million Canadian, with a coupon of 12%. 12%, that was a par bond. To partially fund the GEMS acquisition, we had issued an additional $179 million of notes. That was done at a 8.4% premium to the par value of $165 million on this tranche. If you take that premium into account, it gives you a yield to maturity of 9.5% on the new tranche. So again, the coupon is 12%, but because they were issued at a premium, the yield to maturity on this new tranche is 9.5%. To us, that is an indication that we've been being able to have gone from 12% to 9.5% is an indication of improving credit quality in the company. Putting the two issues together, we now have $305 million of notes outstanding. In addition to the notes, we also put in place a revolving credit facility. The total for this facility, $115 million in available line from a consortium of banks, a syndicate of banks led by Canadian Imperial Bank of Commerce. The entire facility is undrawn at present. This is a 2-year facility. It will have a semi-annual redetermination of the borrowing base, and if drawn, will have an interest rate that will be a benchmark rate. It can be drawn either in Canadian or CAD, plus a rate margin that will be determined by our net debt to EBITDA ratio. But again, facility undrawn provides additional liquidity for the company. Turning to the upper right panel, we just discussed our share count as at November 6, 2025. So the basic shares that are shown here include the issuance of about 649,000 shares to the sellers of Hansa Hydrocarbons. That share count was the equivalent of $12 million US in common equity, pricing for that based on the 20 trading days after the announcement of the GEMS acquisition. So we provided an earlier estimate based on our share price at the time of the deal. Now that we have the volume weighted share price for that 20-day period after the announcement, we can state the final amount of share issuance, and that's that roughly 649,000 shares. Taking into account the dilutive instruments that exist, our fully diluted share count would be 35 million shares. One other item on the slide is the updated guidance on the lower right. Taking into account GEMS, we increased our production guidance for the whole year to a range of 9,500 to 10,000 BOED. Again, this counts the TEN and GEMS volumes after the closing dates, and we have guided to an increased CapEx level to account for activity on TEN and the activity that we expect to have on GEMS, that new range being 100 to 110 million Canadian for drilling and development CapEx. On slide 7, we illustrate the hedge position for Tenaz. This includes hedges that we put in place to cover a portion of the exposure, price exposure generated by GEMS. Of course, GEMS is another predominantly TTF exposure, a very small amount of condensate that is included in the assets. Broken down on this slide, we show the total hedge position of the company for each of the products. So this puts together what we had prior to the GEMS acquisition, plus the new GEMS assets and the hedges that were put in place. And we find that for TTF, we've hedged the majority of our exposure for Q4 25, 56%. We're at a pretty healthy 43% hedging position for 2026 and about 14% in 2027. These are a combination of swaps and collars. For AECO, much weaker price product, we have 13% hedge for Q4 25. That hedge position kicks up to 48% in 26 and 45% in 27. Again, the full range of hedging positions includes both swaps and financial swaps and physical fixed price contracts. With respect to WTI, we have a much more limited exposure, but also a pretty limited hedge position as well. We have about 19% of our oil exposure hedged via collar for the fourth quarter of 25, nothing beyond that. And we have none of the WTI to WCS differential hedged for any time period. The crude that we produce in Canada sells as WCS. It's about a 17 API crude. Does not require any diluent to sell at a WCS marker. and we primarily have let our exposure to that product float with the market. Again, a little bit of TI hedged for via collar for this year. We haven't done anything on the diff side. Diffs have been actually pretty good, pretty narrow, and we have not elected to hedge those for any term right now. As we look at the fundamentals in the TTF market, really our main product, um, we find that there are some positive factors in the market. There's so much discussion of the long-term LNG build out from the United States and from some of the other exporting countries. But if we first focus on the situation for the winter 25-26 period, we find that we enter with actually relatively low EU storage, about 83%, typically would be up in the 90% range, and some years have been higher than that. Has been increased demand uh, in Ukraine as a result of some of the war damage to the industry there. There's a degree of geopolitical uncertainty. So all of these things in the near term, uh, especially if they combine with a relatively cold winter, if that is what happens, does give some upside to prices for the winter term. Over the longer term, we know that there is going to be increases in LNG supply. We do think that the market will absorb this. The forward curve shows lower prices, and part of that certainly can be due to these expectations of increased LNG availability. Nonetheless, this has been a product that has been proved to be absorbed over time. We think there are a number of positive factors in the longer term for gas demand, including its relatively good CO2 signature, uh, the increase in power needs for things like AI, and some other supportive long-term factors driven by just ongoing economic growth in the consuming countries. So um, we're cognizant of the market, and we have hedged out to the end of 27 a significant part of our exposure, and we'll continue to add to these hedge positions as we roll through each of the time periods. Um, an additional item to note on slide 8 is the release of a resource report for the 10 assets. So pretty extensive evaluation that was conducted by McDaniel, independent assessment under uh, the guidance of the Kogi Handbook and the reporting structures of National Instrument 51101 in Canada. Report has an effective date of July 125. So two components to it, a contingent resource evaluation for 10 fields that have been discovered but not brought into production. Uh, and there's a range of estimates uh, uh, which are shown on the slide here. Uh, Probably the best way to look at this is what we call the 2C, or the best estimate, a little bit in excess of 20 million barrels equivalent. Even these contingent resources, though they're discovered, there's a 100% chance of discovery. They go through some risking for chance of development. And as we take that down to a risk number, we have a little bit under 13 million barrels equivalent net to Tenaz from these fields, with an NPV estimated on an ATAX basis by McDaniel of around 97 million euros. There's a larger set of prospective resources. So these are prospects that exist in the 10 portfolio that have not been drilled. There may be well control, there may be seismic indicators to create these prospects. Obviously, there's some combination of these that give us a reason to think that there are hydrocarbon accumulations at these locations, and give us a reason for drilling them. So a total of 67 of these undiscovered prospects were evaluated by McDaniel, um, and leading to again uh, a best prospective resource estimate of about 179 million barrels equivalent on an unrisked basis, net to Tenaz. When that is risked down for chance of discovery, chance of development, we end up with about 61 million barrels equivalent of total risked prospective resource on these 67 prospects. There are two of these prospects that we expect to drill in the upcoming drilling campaign. For those, we asked McDaniel to conduct a full economic evaluation. So only two of the 67, the ones that are planned for the current drilling campaign. Those two prospects, which comprise on an unrisked basis about 4.4 million barrels equivalent net to Tenaz out of that total evaluation of 179 million barrels equivalent for all of the prospects. So a pretty small subset on a volumetric basis of the entire amount that exists within the portfolio at this prospective resource level. The NPV for those two prospects, if you look at it on a unrisked ATAX basis, NPV 10, would be 55 million euros. And once we go through the risking, chance of discovery, chance of development, we end up with a volume of 2.9 million barrels equivalent, mean estimate, and a mean ATAX NPV 10 for those two prospects of about 18 million euros. Next, we review the GEMS acquisition that we announced subsequent to the end of Q3. Really on slide 10, it's a reiteration of our previous disclosure. I would say that the one exception here is that we have been able to exactly quantify the number of shares that are issued for this 12 million US equity component of the consideration. Again, I mentioned it earlier, but that number is about 649,000 shares issued to the sellers of the Hansa Hydrocarbons entity that we purchased. The rest, I think, has already been disclosed in our previous announcement about the acquisition. We're excited about this. We think that it's going to lead to substantial growth for the long term for Tenaz in production and cash flow. We think it's a real value adder to the company. If we move on to just a reiteration of the Tenaz record on the next section, we have our typical four-panel slide on slide 12 here. Substantial increase in production since Tenaz began with the recap of Altura. So even more of an increase in funds flow from operations. And we're happy, very honored that we've had the stock price performance that we have had, a TSR of 1,380% since the recap in August 21. That price appreciation places us among the very top issuers on the entire TSX list since the date that the recap was announced, and we appreciate the support of all of our shareholders during this time. Really, in summary, on slide 14, the model of the company has not changed. We think we have realized and we continue to see deep value in the international market. We continue to develop our acquisition pipeline, trying to add new prospects to it and also advance the ones that have already been in there. We're not stopping just because we've made what we think is a very good deal in buying the GEMS assets. Management team remains the same, and we think experienced in running the strategy, very focused on adding value for the existing shareholders. And really, that's the final point on this slide as well, that everyone in Tenaz is incentivized to deliver for shareholders, and it's very much our intent to, in all of our activities, our M&A activities and our operating activities, to execute in a way that adds value for the existing shareholder group. I mentioned at the beginning of the presentation our investor advisories that continue on slide 15. I thank you for your interest in Tenaz, and we look forward to our next opportunity to review our year-end results. Thank you.